Today, I'm going to look at 3 stocks that recently made bullish crossovers. I'm not talking about meme stocks. I'm talking about blue chip stocks and taking a look at whether now's a good time to buy them. So the first stock on my list here is Apple. So Apple's 20-day moving average recently crossed above its 50-day moving average. That's a pretty positive technical indicator and a sign that the short-term momentum has been accelerating. As we can see, the stock is at 187 right now, and the relative strength index at 68. So it's getting pretty close to what you consider overbought levels at around 70. So another sign that it's been heating up. Obviously, Apple's been doing well recently. They announced a really big buyback, and so that's been making people more bullish on the company's results. From a valuation standpoint, let's take a look at its numbers. So 2.9 trillion market cap, a forward PE of 28, a little bit high, but not high compared to some other tech stocks. PEG ratio of 2 seems to be high. A book value of 38 is massive, but that's not really helpful in the tech industry. But overall, Apple's valuation doesn't look too bad. Forward PE of 28 is not bad, given that it's still a really solid business, a lot of potential to continue growing its service business, and the new iPhone coming out later this year. I think that could still accelerate its growth, because the big problem with Apple has been its sales have been slowing down. So generally, you don't want to be paying close to 30 times earnings normally for a company that's growing its business in just mid single digits or low single digits. And right now with AI powered phones coming out, I think its growth rate could improve in future periods. So I think Apple's definitely a stock to keep an eye on. It could be a good buy, especially for the long term. Next up is United Health Group. This is another stock that recently made the same bullish crossover. So the green line is its 20-day moving average. So it recently cut above its 50-day moving average. That was about a week ago. And the stock at 513, so trading around where it was back towards the end of February. So it's been on a bit of a decline just because medical costs have been up. There's more people making claims this year, return to normal, all that sort of stuff. And if we look at the RSI, also around 67. So just like Apple, it's getting close to that overbought territory. Typically, United Health is a fairly safe stock. Doesn't normally go that volatile or go that high up on the RSI scale. Now, in terms of its actual statistics, let's take a look at its numbers. So 31 times trailing earnings, but on a forward basis, only at a multiple of 18. So fairly decent in terms of that. Its PEG ratio is less than 2. So a more reasonable valuation than Apple. And with United Health, you're also getting a pretty good dividend with the stock. So right now, its dividend yield is about 1.5%, but United Health's been increasing its dividend for years. So another really good option for the long term. And the fact that right now the stock's picking up steam, that's a good sign that investors are starting to pay more attention to it and aren't too worried about those rising medical costs. But it was realistically, that's probably a short-term problem for United Health. In the long run, it's still a good investment to hang on to. Next on my list is Costco Wholesale. So another stock that's been picking up. And as we can see, that green line, that 20-day moving average crossed above that purple line, the 50-day moving average. And that happened right around about 4 or 5 days ago. So just recently made that crossover. And it recently was in overbought territory. RSI right now around 67. So again, hovering around those levels. Now, let's take a look at its valuation. Costco is a bit expensive. I mean, it's trading at 51 times trailing earnings, 45 times forward PE, 5 times for a PEG ratio is enormously high. So, I mean, this is probably the most expensive stock on this list. And Costco is no tech stock. It's no Apple. Its growth rate is going to be a bit more modest. So this is probably the one stock on this list I wouldn't say is a really great buy at these levels, because people are paying a huge premium for Costco, and that's, as you can see, it's been the norm in the past. But as you can see, a year ago it was only at 36, 37 times earnings. So I think people have been a bit overly bullish on its prospects. It still has a lot of growth, but at 50 times earnings, 51 times earnings, I mean, that's a steep multiple. Even if the stock is gaining momentum, I don't think Costco is going to have as much upside as the other ones. So it is climbing, but may not be as great of a buy, may not have as much upside, I think, in the near term as United Health or Apple. So those are 3 stocks that are doing well right now. Apple, United Health, Costco all recently made some bullish crossovers, but I think United Health and Apple are the better options at this point, just because their valuations are better, and there's more reasons to be optimistic on how they'll do over the next 12 months or so.